Hello, and welcome back to this month's episode of the Investment Insight Series. I'm Tyler Ellegard, and I'm joined here with Keith Gangl, Senior Portfolio Manager, Gradient Investments. Keith, Thanks for joining.
Thanks for having me. Lisa's on a little bit of a mini break here, so
She is.
Tyler and I are filling in,
Yeah.
so everyone just stay with us.
Stay with us. But as always, we're going to look at the year-to-date asset class returns just because it's a good recap of what's kind of happened the last month or so since we last recorded. And you can see here, U.S. large cap stocks doing quite well, up 10.1% as of the end of July. But then small cap stocks are doing even better, it's been a long time since we've seen small cap stocks do this well and even outperform their large cap peers. And then you also have international developed stocks doing well. And then emerging markets has actually been quite the surprise, up 18.3% so far this year. They've gotten a lot of attention lately. I think there's a lot of interesting stuff going on that we won't get into today, just because we have I think a more interesting topic right now to talk about. Going through some of the other asset classes, gold is actually pulling back this year, which is a little bit of a surprise with everything going on.
It's been a couple strong years in a row.
Yeah. And then Bitcoin, again, down 25% so far this year. So there's a lot going on in the markets. And so I think what I want to talk to you about today, Keith, is why is the market so strong? Because we get a lot of the questions about market was up 26% back in 2023. It was up 25% in 2024, 17% last year. And now we're up 10.1% so far this year. So the questions always come in of why is the market up as much as it is, despite all of the other stuff that's going on?
Yeah, the one key word I have to say is earnings. And actually, as we're recording here, we're a couple weeks into August, and we're actually seeing earnings season. Right, we're almost towards the tail end of it. Mm-hmm. They've been phenomenal. So I'm a believer. I think most of us are in the investment department. Is stock market follows long-term averages or the growth rate of corporate earnings.
Yep.
And they've been phenomenal. I mean, been doing this for a long time. In this period we're seeing right now, the projected earnings for this year are expected to be 20. They were at 24. They were at 18%. They went to 24. And I think we're right now around 26%.
Yep.
That is great. So we just finished Q2 earnings season. That's kind of that 3-week period where companies kind of give us our scorecard, how are they doing, kind of give us projections going forward. And numbers are actually continue to creep up a little bit. So this chart here just looks at the number of companies guiding higher. And I think we're about 90% through the earnings season, and it's 85% of the companies are beating and guiding higher. Mm-hmm. That's a great number. You don't see that kind of number unless you're coming out of typically a recession, right, when numbers come depressed, and then you have a lower base to grow off of. But we're growing off a high base. You just mentioned we were at 20, 25, 26, 25, and 17. Those are some big numbers, and those were healthy growth years. Last year, I think we were high teens. Yeah. So now you're growing off high teens. You're going to 24, 26% plus. That is why the stock market is doing what it does. We get this question constantly from advisors and clients, and we just had it from a couple people internally that why is the market doing so well? You hear about Iran and tariffs and this and that and oil prices, inflation, and the bond, the Fed. It's really, we point back to corporate earnings.
Yeah. Well, I think you brought up a really interesting point that we typically, going through the years, and this is why I want to bring this chart up, is you just hit on it, where typically earnings throughout the year, it starts high, starts in the mid-teens to low teens growth rate expectations, and then throughout the year, it tends to trickle down to that 7 to 9% earnings growth, and rightfully so, the market tends to be up 7 to 9% on an average basis, so it kind of fits in line. But what we're seeing right now is very, very different. So if you can walk us through this chart, I think that would be really interesting.
Yeah, this chart here, the line kind of going down directionally, is the kind of the earnings forecast, the change going forward since 2000.
The changes throughout the year.
Throughout the year, it's actually negative, right? Yeah. You're going, so that to your point is, basically analysts, more the sell side analysts, we don't put our numbers out there, but they'll put their numbers out, and traditionally they've been a little bit more optimistic of how the year is going to go, right? And all of a sudden you get Q1, good solid season, let's take numbers down a little bit. Q2, same thing. We've seen the exact opposite last year, and then this year is really accelerating. Mm-hmm. And there's various reasons. I mean, the one thing that easily you can point to is AI. AI is kind of making everything a lot more efficient, a lot of earnings growth rate. You've had, but the market's broadening out to your earlier slide of small cap and international emerging markets. So things are getting better, not only just for those technology kind of growth names, AI related, but it's the data centers, it's industrials, it's healthcare, it's energy. Energy's been phenomenal this year. So this year is a little bit of an anomaly. Normally, like I said, for the last couple of decades, it's been down to the right on revisions. This year, it's just the exact opposite, and that's what this chart shows.
Which is pretty incredible when you think about just how many companies are in the S&P and how many companies are probably benefiting from AI and truly what it's doing to the earnings expectations.
Yep.
And so when we think about earnings and the growth rate of earnings for stocks, because we often talk about the market tends to follow earnings. And so if we think about what companies are actually doing from a fundamental standpoint, earnings are the most important thing.
They are.
And so again, another chart that you've brought in here is showing the growth, the accelerating growth of earnings for companies and this isn't even just, this chart doesn't even have the S&P 500, it's even broader than that. It's the Russell 3000, which includes large cap, mid cap, and small cap. So if you want to walk us through this, that'd be...
Yeah, this chart goes back to 2021, right? When, remember 2020, everybody remembers COVID, right? The shutdown.
Yep.
And coming out of COVID, we've seen an earnings reacceleration. That's what you see here, up 16% in that first quarter, really, when the companies were back open, right? After they had to slam the doors shut, earnings basically fell off a cliff. And so then have a 16% growth rate. Yeah, it's reasonable, right? After that basically such a negative previous year. But then you kind of got a little bit of a slowdown, the growth scare in 21 into 22. And that's where you've seen it actually dip. But now you see here, it's up 15%, the median on those 3,000 companies. You're right, it's not just the largest 500. And that's when we talk about broadening out. We certainly see it. And this chart does a great example of here's what it should historically is coming out of recession, big numbers. Then you get a slowdown period, and then you get a little bit of negative, and now we're reaccelerating again. You take a long-term average is about, which I don't think we put on this chart, is about 7 to 8% of earnings growth rate. So if we did high teens last year and do 25, 26%, those are some big numbers.
Yeah. And then switching to this chart, I think this is probably one of the most important charts that you can look at, because we can sit here all day long and talk about how the market follows earnings and earnings drive the market, expectations drive the market, but when push comes to shove, what does that actually look like?
Yeah.
And so you've brought in a really interesting chart, so if you want to walk us through this one.
Yeah, this is the S&P 500 with an overlay of the S&P 500 earnings, right? Those are those 500 companies. We look at each of the individual earnings and add them together, and that's kind of the S&P 500 earnings. The aggregate number, right? And so again, this is the S&P 500 is that kind of lighter line, and the blue line is the S&P 500 index. And you can see, going back, this is the last 30 years. There was a chart that I saw at 90 years, but then I made everything so small at the end. So I just went back 30 years. And directionally, you can see when earnings are going up and to the right, the stock market's following. Now this chart just went to the last quarter, or first quarter.
Yep.
And those little kind of dips at the end, those have actually reaccelerated now again. So again, earnings, stock market are following earnings. And this, again, this is back 30 years. And you can see directionally when the earnings are going up, the stock market goes up.
When you actually put the two charts together, it actually shows.
Makes sense, right?
It makes sense of why the market does what it does.
And you can see the dips like in 2020, that in those different periods when markets drop, that's what earnings are dropping as well.
And so as we're on this chart, I do want to ask you, because we do get a lot of questions internally, externally about why is the market doing so well. So if you want to answer that question right now.
Yeah, we believe the market is doing so well is because of corporate earnings are doing so well. And there's factors that go into corporate earnings. It's whether it's sales growth, kind of accelerating, margins getting better, maybe AI is making everything a little more efficient, right? There's various things that make earnings get better, but that is the single one answer we would answer everybody is like, it's earnings. Forget about all this stuff going on with, the Middle East and inflation. And again, those are important. We do consider them. But if we had to pick one factor alone, again, we don't just pick one factor, but this is what's driving the stock market, we believe.
Yeah. And so I think what's important to understand is everybody talks about AI and the benefits it can have, the efficiencies it can create, but there's a few big companies that are really driving the AI train. And obviously earnings from whether it's industrials, financials, materials, utilities, all of that money has to come from somewhere. It doesn't just come out of thin air. Doesn't grow on trees, as my parents would say. So if you can walk us through where that money is actually coming from.
Yeah, it comes from cash flow. It comes from the hyperscalers, and a couple of them here you mentioned on this chart here are Meta and Alphabet. Those are a couple of the larger ones. There's Amazon, and there's a few others that that are big spenders. These are the hyperscalers. These are the cloud. These are kind of the build out of. These guys are the ones that are buying those NVIDIA chipsets, right? NVIDIA was the leader in AI. That was, anybody heard AI a couple years ago? The name you thought of? NVIDIA.
Yep.
And now it's starting to broaden out, like you said, it's the data center build. It's all the infrastructure that goes with it. And that's helping all those earnings, those industrial companies, those financial companies, those companies like, now these companies had great cash flow. And so these guys, the Mag 7, which contain a lot of these hyperscalers, did phenomenally well for several years, and lately then they've been called the Lag 7, right? Because part of the reason that, if you look at this chart, we believe earnings drive stock, stock prices. Another thing that drives stock prices is cash flow.
Yep.
So when your cash flow is, you have a lot of cash flow, you can do different projects, but also when you start spending a lot on, AI, your cash flow goes negative. So we're in that kind of a weird period. Now, most people are thinking that's going to only be a year or two of this hyper spend, but we're forecast for next year is over $1 trillion.
Yeah.
That's a big number, right?
That's a big number.
You got Amazon doing a couple $100 billion a year. You got, Alphabet, Microsoft, all these guys doing, 100 to 250 billion. That adds up pretty quickly.
It adds up quick.
And that dollar amount is going somewhere out in the economy. It's helping a lot of these other companies, which has helped push up the earnings of these companies.
Well, that's why I think this chart is so interesting, because you can see that Google had $24.5 billion of free cash flow, which means cash coming in minus the capital expenditures that they have. So that's net for them to do additional projects, to do stock buybacks, to do dividends. So it affords them to do a lot of different stuff, and that's just one quarter. And all of a sudden, if you fast forward to this last quarter, they're negative basically $6 billion, which means they've spent that extra 24.5. That doesn't include the cash that they're already spending on the CapEx. That's additional CapEx that they're now spending. So that's almost over $30 billion swing in just a year.
Yeah.
And that money has to go somewhere.
Where do they get it from as well?
Well, so one thing that a lot of these companies have been doing, so we've for the last decade, we've heard about stock buybacks.
Yep.
So these companies aren't doing those anymore, number one.
Yep.
So instead, they're actually doing stock issuance, which means they're issuing more
crazy,
stock
which is
and
crazy
diluting.
for these Mag 7 guys, right?
And so if you own one share of Google, they're now diluting your share. They're also doing debt offerings, right? Yep. So they're going to the banks to have Goldman Sachs, JP Morgan, Morgan Stanley, all of these different investment banks offer the stock and create debt. Or they're going to the private markets. Last month we talked about alternative assets, private markets. They're also going to what's called the direct lending, which is private credit. They're also going to structure those deals there too. So giving a tie back to last month's video. So that's really where they're getting in. So that's why when we talk about financials, it's always more money center banks.
Yeah, and they benefit, right? Because all the issuance of Morgan Stanley and Goldman Sachs, these guys are issuing new issues. The companies don't necessarily do it themselves. They go through these banks, which that helps their business model as well.
So then when we talk about markets and they're doing so well, earnings is doing great, but we also have to consider what the valuation of the overall market or individual stocks look like. Because at the end of the day, you could have a stock growing, let's just say 50%, but if it's priced at a very, very, very expensive valuation, it might not be as attractive.
For sure.
So you have to understand where the actual pricing is of the market, and is it cheap enough? Is it opportunistic enough to actually get in, or do you need to pull back on how much equities you have, things like that. So why don't you walk us through what that looks like and where we're sitting today?
Yeah, so valuation is what you want to pay for the market. And one way to do it is a price to earnings multiple. And that's why we focus the whole thing on earnings, right? When earnings are growing a lot, that generally means your PE multiple is going down, right? So if we look at all those 500 companies, we look at their earnings in aggregate, they're going up. And then let's just say, for example, this year, let's do rough numbers of 25%. We're halfway, two-thirds of the way through the year. Markets have gone from up 10% to currently are up about almost 15%. So they're up 15%. Earnings growth in the forward is up 25. That's more than the actual, right? Than the stock market is returning. So that means earnings are growing faster than the market is, so your PE multiple is actually compressing, which is, I think, is a very healthy thing. It's because sometimes you get into periods where the multiples just expand in the market. That means you're just more willing to pay for, kind of like if you were going for a shopping you're paying up. Like if you're going shopping for a house or a car, you can use that analogy. Like there's some periods where people just want to pay up. Maybe it's because interest rates are low, or they have a car that they have to buy, so they pay maybe more than they need to, or in a rational moment, right? So same thing with the stock market. There's periods where people overpay on valuation and then hope the stocks kind of grow into the valuation. I think right now is earnings are so good, valuations coming down. I think this is a very healthy thing. Now the question we'll get later this year, and I think we talked about it a little earlier today on our podcast, is I think this earnings has been so good the last couple of years, we might be stealing a little bit from next year, right? Because of the law of large numbers. If you did 18% last year and you do 25% this year, at some point in time, you're going to have to slow down. And so when you do that slowdown, then people are like, oh, maybe it's going to be at 12%, which is still above the average of 7 to 8, but maybe that might be a little disappointing. So that's something to keep an eye on.
And you don't want to pay the 22, 20 times that
multiple
we're sitting at right now.
And then maybe you end up paying 16, 17, and we're at 19 currently.
Well, Keith, thank you so much for coming on today. We're going to wrap it up here. So just in closing, the stock market, it's continued to perform very well this year. And again, Keith alluded to it. A lot of it is being driven by the strong earnings that we've had, not only on the quarterly basis, but the expectation going forward with the 24-25% expectation of growth for this year and another 15 to 18% next year. So that is really why, in our opinion, why the market has been so strong this year, despite the past performance that we've had the last 4 years. And it truly is the most important part is the earnings expectations. Those continue to rise, and as we had a chart, typically those go down. This year, they're actually accelerating and going higher from where we started the year. And AI, the spending is a lot of those earnings have come from the AI spend, and we expect that to continue going forward, but that's really what's creating the tailwinds. So we really appreciate you taking the time today to listen to our Investment Insight series, and we will see you guys next month for a new exciting topic.